Many people that have extra saving ask the question of where is the best place to put my money? Now, typically they ask whether it's better to invest or better to pay down their mortgage. Today, we're going to look at those two options and see what is the better outcome and which one will actually help you be more financially in a better position in retirement. We're going to weigh the potential long-term benefits as well as financial security of paying down your mortgage a bit quicker, but also gain valuable insight on different factors such as your net worth, your spending in retirement, your risk, time horizon, and all of that. Whether you're a homeowner looking to seek advice on whether to prepay your mortgage or an investor looking to maximize potentially higher returns and be able to spend more later in life, hopefully this video is valuable to you and allows you to make an informed decision on what is best for you. Now, keep in mind that everyone is different. Everyone's scenario and financial circumstance varies and everyone has a unique situation. So make sure to do your due diligence or talk to a professional about this to fit your needs. The first option we're going to look at is the case for paying down your mortgage a bit quicker and some of the key advantages to doing so. Being able to prepay your mortgage reduces your debt down the road and also gives you a little bit more of financial security or peace of mind, not having a large amount of debt, typically your mortgage, while entering into the later phase of your employment or potentially into retirement. The second, by paying off your mortgage a bit earlier, you reduce your risk to interest rates, foreclosure, and allow you to have home ownership early in life. Number three, and I'm sure you guys are aware that paying down your mortgage sooner allows you to have more interest savings than if you were to just keep up with the regular schedule. Now, weighing the benefits of whether that extra dollar should be invested or paying the mortgage, we'll dive deeper into that, but it does come with some interest savings and it's also guaranteed, meaning the rate that you're paying for your mortgage, the interest rate, the prepayment is going directly towards principal. So you're saving that amount guaranteed directly. And the last thing to kind of keep in mind is if this is your second property or investment property, your mortgage may be tax deductible, and that makes the scenario a bit different of whether it makes sense to prepay your mortgage or to invest. Now, moving into a couple of the drawbacks of prepaying your mortgage, we're going to look into those. So number one, by prepaying or putting more money towards your mortgage, you're allocating your funds into an illiquid investment. Your home is not able to be sold relatively quick. It might take a couple of weeks, a couple of months to be able to actually get that cash in hand, whereas an investment you can sell in the next day or in a couple of business days, that money's in your account. Second, this lack of flexibility financially may hinder you from potential investment opportunities that come down the road. The third being mortgage interest rates are typically lower than higher investment returns elsewhere. So if there's a different spread, typically it makes more sense to tuck in towards investments, but we're going to actually dive into that data later and look at the software and what that actually means. And then also utilizing accounts such as your TFSA or your RSP, not being able to maximize or use efficiency through tax savings, through not paying tax at all, can be one hindrance of prepaying your mortgage. Now let's shift our mindset to option number two, the case for investing. Now there's tons of advantages of investing. Obviously your money grows over time, and the sooner on that you start investing, the more it's able to compound and to grow. But there are a couple other key advantages to allocating extra dollars to investments towards prepaying your mortgage. We talked about liquidity. Obviously being able to invest, you have a bit more liquidity. You're able to access that capital a lot sooner than if it was tied up in your home. But the other advantages is you're diversified. You're able to not have all your eggs in one basket. For example, your mortgage or your real estate is one investment product, but you're able to diversify and have multiple different types of investments so that you're not just risking it all in one area. Another benefit to investing is it opens up a world of different options. You can invest in stocks, bonds, ETFs, mutual funds, many different options that allow you to be flexible. And the final benefit of investing is potential employer matching. Of course, we talk about this in the channel a couple of times, but free money is always good money. If your employer is willing to give you money based on what you put in, always take it. Now, some risks and caveats to investing is obviously you're taking on risk. You're taking on more risk than if you were just to prepay your mortgage and have that guaranteed interest expense reduced. You have to take on some sort of risk in order for your money to grow. It also requires careful research, analysis, and the ability to make a financial decision, especially if you're stock picking. Which kind of leads into my next point is individual decisions can really impact your investment returns. If you make a wrong choice on a stock, obviously it would be better to prepay your mortgage than to make a poor decision on an investment and be down 20-30%. Another thing is it's crucial to assess your risk tolerance, your time horizon, your financial goals as well. And this is typically where a financial professional or someone in the industry can help you determine this so that you're investing adequately. So let's hop into the software and see whether it makes sense to pay off your mortgage through prepayments and get it done a little bit earlier, or to invest those extra dollars. And let's see what the data actually shows. So if we hop in here, we can see Dan Professional. He is making an approximate income of $90,000. It's gonna be growing with inflation. He's at the age of 35, so kind of in that middle area where you might be purchasing a home and then also having a bit of extra cash flow. Currently, he purchased a property for $750,000. His mortgage is gonna be around $500,000, but he has some assets built up, about $50,000 in the TFSA and $50,000 in the RSP. Now he's got a $500,000 mortgage, as you can see, 5%, looking to pay about a 30-year amortization. So around $2,684. Now we're just using this example of 5% because we're using that as the investment return, but also the mortgage over the span of the loan, just to see what kind of makes sense and how beneficial it is to prepay or to invest. So this is just the status quo example. Dan is looking to just tuck away about 10% of his income, split between the TFSA and the RSP, keep up with his mortgage payment, which is around $32,000 annually. And you can see just as he hits retirement, his mortgage is gonna be paid off. So the ideal scenario. And at retirement, he's gonna have around $1.2 million of assets. And you can see with no planning whatsoever, but CPP and OAS 3965, no real account or tax planning, but he's able to have $46,931, or just shy of $47,000, from 65 adjusted to inflation all the way till 100. So keep in mind that number as we look into investing, and Dan is able to contribute an additional $3,000 a year to his investment accounts, and how that kind of affects his numbers potentially in retirement. So if you scroll down, it's an extra $3,000, split 50-50 between the two accounts. But if you scroll down to the very bottom, we can see the same thing. The mortgage is being paid off just before retirement. He's gonna have just over 1.4-ish million in retirement, and it allows him to have around $52,000 of after-tax income adjusted for inflation until age 100. So $52,273. Let's look if he was to pay that extra $3,000 a year into his mortgage and then adjust that amount that he would have been putting towards his mortgage and start pumping his accounts right before retirement. So as you can see, that $35,208 compared to that $32,000, bumping it up, prepaying it, and this will mean that he'll be able to have it fully paid off by the time he turns 59. And so after that, we're gonna look at bumping up his saving a lot more, because he obviously doesn't have any debt payments. And by the time he hits retirement, he'll just be shy of $1.35 million. So slightly under what he would have done if he's investing. Now keep in mind, this is a 5% rate of return for both the TFSA and the RSP, and also a 5% on the mortgage, which leaves them with $50,860 from 65 adjusted for inflation till age 100. So overall, if you look at the two examples, mortgage prepayment is $50,860, whereas investments would be around $52,273. So about $2,000 more after tax adjusted for inflation by contributing more to his investments compared to prepaying his mortgage. Now, there's a couple of things to consider here. Obviously, it doesn't take into account taxes. It's not taking into account the tax savings that from the RSP, the TFSA, using all these different things, assuming the risk or the rate of return that he's actually getting. A couple of unknowns here compared to the safer route, which is prepaying your mortgage, but it still gives you a good idea that there is a little bit of an advantage to invest than to prepay your mortgage overall. Now, one thing that I would suggest is there's no right or wrong answer, and everyone's scenarios could be very different, but being able to find the right balance between the two, investing and prepaying your mortgage potentially. Many things might change as interest rates change throughout the years, as potentially rates of returns change. These all play into effect, and there's a lot of unknowns. Even with the example, it's still 30 years from retirement, a lot can happen in that 30-year time period. But having a general grasp of the pros and cons and making an informed decision is overall important. There's no one size fits all, so consider your risk tolerance, what you're comfortable with, and talk to a professional about what fits your scenario the best. Thank you very much, guys. I hope that you're able to learn a little bit about the pros and cons to prepaying your mortgage and investing, and being able to dive a bit into the data and what it shows. In the end, remember, your scenario is going to be very different from everyone else's. So do not take one scenario as that's applicable to you. Make sure to assess your own specifically. We thank you for watching this video, and we look forward to seeing you in the next one.